Hi guys. So for today's lecture, we're going to be talking about the second part of chapter 5. So we're going to be talking about the forward market for foreign exchange. Yeah. So this is a continuing from week 3 where we talk about the spot market. Okay. So let me share the slides with you first before we start. Alrighty. So let's go through our materials for today. So the agenda for today is number one, we're going to be talking about the main features of the forward market. So we'll talk first about the different types of forward contracts. So we'll talk about a short forward position and a long forward position, right? And then we'll be talking about how traders can use forward contracts for different purposes. We then move on to the futures contract, the options contract, and finally we'll talk about some different investment opportunities, different investment options for people who wants to invest in currency, right? Now, throughout these slides, you see that I have put in a few additional problems for us to solve throughout the different topics, okay? Okay, so just to define the forward contracts. So forward contracts are contracts to buy or sell foreign currencies in the future at the price agreed upon today. Okay, so these are contracts for a future settlement of currencies. Say, for example, if I need to buy something from the UK and they invoice me in 3 months' time, right? So it's a future delivery of foreign currencies. But for these contracts, under these contracts, you can specify the price today, okay? In contrast with the spot market, it will be the prices that you trade for the current delivery, right? So you trade the currency straight away. Now, with the forward contracts, it's normally short-term contracts in the sense that it will be quoted for 1, 3, 6, 9, or up to 12 months. So for people that have a longer time horizon, so if you have a contract that is settled in say 3 years, then you can use something called swap, okay? So a swap is like a series of forward contracts where you can basically roll forward the contracts until a longer maturity, right? So for the purpose of our subject, we want to focus on the forward contracts, not so much on swap, okay? So in terms of forward quotation, we will be seeing the same table that we saw from last week. So in this table, what I have is I have the currency prices in the USD as well as the per USD value, right? So on the first slide, on the first row, I've got the spot rate. So this is the value of the pound at the current time, right, in the spot market. Now the next few rows are the prices of the pounds in the forward market, okay? So with the first row, this is the price of the pound for a 1 month forward contract, which means that if you want to say buy the pounds for a 1 month delivery in the future, you can lock in a rate of 1.4403 today, okay? So in 1 month's time, you'll be delivering your pounds or you'll be buying your pounds, depending on whether you're buyer or seller. And you'll be settling the contract at 1.4403 USD, okay, per pound. Similarly, we've got the price or the forward exchange rate for a 3-month contract, and we have the forward exchange rate for the 6-month contract, okay? So considering the example we have here on the slide, now if my spot exchange rate, which is here, is 1.4402, that means at the current market rate, I'll be trading 1 pound for 1.4402 USD, right? Now, if my 6-month forward contract, so 6 months is 180 days. If my 6-month forward contract is 1.4416, that means at the current time, the market is trading the pounds for a 6-month delivery at 1.4416, right? What does it mean? Okay, so if I compare the spot market rate and the forward rate for a 6-month delivery, I can see that the spot rate is lower than the forward rate, right? Which means people are expecting that in 6 months' time, the pounds will be a bit more expensive, okay? So the difference between your spot market rate and your forward rate tells you about the future expectation of the exchange rate, okay? So in this case, it looks like people are expecting the pound to appreciate in the future, okay, against the dollar. Okay, so in terms of quotation, in the forward market, there are two ways that we can price or we can quote the forward rates. The first way is just similar to the spot market where you just give the prices directly, right? So for example, if I look at my 1-month forward rate for the Swiss franc over the USD exchange rate, so for the 1-month forward contracts, one Swiss franc is currently buying at 0.9764 USD, and at the same time, the bank is selling the franc at 0.9769. Okay. So with the second quotation method, so in this case, what we can do is we can quote the forward point instead of giving the direct forward exchange rates, right? So these are the forward points. So what they are the last 2 digits of the forward rate, okay? So 12 here means 12 basis points. That means 0.0012. And 10 here means 10 basis points. So 0.0010, okay? So as a rule of thumb, whenever your left number in the forward point quotation is less than the right number, you would add these numbers onto the spot exchange rate to find the forward exchange rate. Whenever you have your left number higher than your right number, then you would want to subtract these rates from the spot exchange rate to get the forward rate, okay? So for example, let's look at the 1-month forward rate. Now, if we look at these rates here, we will see that the left number, which is 12, is higher than the right number, okay, which is 10. So because the left number is greater than the right number, I'm going to be subtracting these basis points from the spot rate, okay, to find my 1-month forward rate. So in terms of the bid rate, I'm going to be subtracting 12 basis points from the current bid rate. So I'm going to be doing this. And that will give me 0.9764, okay? In terms of the ask rate, I'm going to be taking the ask spot rate, and I'm going to minus that with the right-hand side number, which is 0.0010, and that will give me 0.9769, okay? So based on these calculations, this will be my bid forward rate for the 1-month contract, and this will be the ask forward rate for the 1-month contract, okay? So you can do the same thing with the other two as an example. Okay, so based on the forward rates and the spot market rate, you can also calculate something that we call a forward premium or a forward discount, okay? So a forward premium or a forward discount simply just tells you the difference between the forward contract, the exchange rate in the forward contract, and the spot market, okay? So as we mentioned before, when we look at the difference between the spot forward rate and between the spot exchange rate and the forward rate, it tells us about investors' expectation about the future. Okay, so when the forward rate is higher than the spot rate, that means people are expecting the currency to appreciate, and vice versa. Okay. So in this case, if I want to compute how much the currency is expected to appreciate, I can calculate the forward premium or the discount in the case of depreciation, right? So in this formula, I'm going to call F as the forward premium or discount, and it will be given by the difference between the forward rate and the spot rate divided by the spot rate, okay? And then I'm going to annualize it by times it with 360 divided by T, okay? Where T is the number of days forward. So the number of days until maturity of the forward contract, okay? So if 360 is just the number of days per year in the US system, okay? So I don't know how, but they come up with the 360 number. So if the forward rate is positive, so if F is positive, that means the denominator currency is trading at a forward premium, right? So a denominator currency is, for example, if I have this exchange rate over here, in this case, my denominator currency is the US, and this is what we call a commodity currency, right? So when we have an exchange rate of Australian dollar over USD, we are pricing the USD in the Australian dollar, okay? So in this case, when F is positive, that means the commodity currency or the denominator currency is trading at a premium, okay? So people are expecting the commodity currency to appreciate in the future, okay? Alternatively, if F is less than 0, that means we are expecting the commodity currency to be trading at a forward discount, okay? So in this case, we are expecting the commodity currency to be depreciating, okay? So for example, let's look at this exchange rate here. So in this case, we have the USD divided by the euro, okay? So in this exchange rate, the euro is my commodity currency, right? So the current spot rate for the US over the euro exchange rate is 1.1329. And the forward rate for a 6-month contract, so a 180-day contract, is 1.1389, okay? So if I just look at these two numbers here, I can see that the market is expecting the euro to appreciate in the future, right? So because the forward rate is higher than the spot rate, okay? So if I want to compute the 180-day forward premium or a 6-month forward premium for the euro, I'm just gonna put a bracket here. This is for the euro, okay, which is the denominator currency. I'll be applying this formula here. So I'll take the difference between the 6-month forward rate and the current spot rate. I'll divide it by the current spot rate. I'll times 360 divided by T, okay? So in this case, T is 180 days, which is the maturity of the contract, okay? So when I calculate this bit here in the equation, it will give me the forward premium for the period of the contract, okay? So for the duration of the contract, which is 180 days in this case, I would then annualize it by times it with this fraction over here, okay? So overall, I get the result of 1.2%, and this is on a per annum basis, okay? So this is a yearly basis, right? Because I already annualized my result. All right, so let's look at another example. So in this example, can you guys help me to compute the forward discount or premium for the Japanese yen against the USD, right? So this example is taken from tutorial question 6. And let's go through the question, okay? So I'm just gonna write down the name of each of the column. Okay, so let's go through the question. Now the question asks us to use Exhibit 5.4 to calculate the 1 and 3 and 6 month forward premium or discount for the Japanese yen against the USD, right? So this sentence tells you that you're going to be calculating the forward premiums or discount for the Japanese yen, okay? So not the USD, but the Japanese yen, okay? So as a result, we find out that for this question, the Japanese yen is the commodity, okay? So the rate that I'm interested in is therefore this exchange rate over here, where my Japanese yen is the denominator, okay? So this is the value of the Japanese yen in the USD, okay? And as a result, from this table, I'll be looking at this column over here, okay? So let's go through this calculation, and for simplicity, at the moment, let's just assume that every month has 30 days, right? So can you guys go through this example? Let's say just look at the 1 month contract first. Let's take 1 or 2 minutes to work through this problem. And when we come back, we will be going through the solution together, okay? So let's work through the 1 month contract first. And in your own time, we can work through the 3 month and the 6 month contract later on, okay? So I'll give you guys about 1 minute to work through the first contract, okay? Okay, so let's go through the answer together. So we're gonna start with the formula first. So here I'm gonna be starting with my forward rate formula. So on the left-hand side, I've got my forward rate. On the right-hand side, I've got my, on the left-hand side, I've got the forward discount or premium. On the right-hand side, I've got my forward rate, the USD divided by Japanese rate, because I want to compute the discount or premium of the Japanese yen. right? So I'll take that, I'll minus it with the current spot rate, and I'll divide it by this current spot rate, and I'll times it by 360 divided by T, okay? So for the 1 month forward contract, the T would be 30 days, which is the number of days in the year, in the month, right? So if I put everything in the formula for the 1 month forward rate first, I will find that we have a forward premium of 0.92% per year, okay, for the 1 month forward contract. If I apply the same formula for the other two contracts, I'll find that I've got a forward premium of 1.13 per 3 months, per year for the 3 month contract. And for the 6 months contract, I've got 1.26, okay, per annum. So what does this number mean? That means over the next 6 months, investors expect that the Japanese yen will appreciate, right? So if you compare the spot exchange rate and the forward exchange rates, you will see that the Japanese yen is expected to increase, okay, against the USD, okay. Now, in contrast, if you look at the per USD values, now these are the values of 1 USD in the Japanese yen, right? Like we said last week. If you look at these values here, you will see that the USD is expected to depreciate over time, right, against the Japanese yen, okay? So if one currency is expected to appreciate, then the other currency is expected to depreciate, okay? All right, so in the next slide, we'll be talking about the different positions in the forward contract. So in a forward contract, you could either take a long position or you could either take a short position, right? So when we say we have a short position in anything, not in just a forward contract, but if you have a short position, that means you're selling something, okay? So short is sell. In contrast, if you have a long position, that means you're buying something, okay? So under a forward contract, if you are long in a forward contract, say if I long in a euro forward contract, that means I'll be buying the euro forward, okay? So I'll be buying the euro for a future delivery, okay? So in a forward contract, the forward rate or the price that we agree on in the forward contract is called F. So F is just the forward rate, okay? As opposed to S, which is the spot rate, okay? So under a forward contract, you will be specifying the forward rate, which is the rate that you settle the currency at. For example, if we look at a long contract for a 6 month position in the pounds, okay? So in this example, we have a 6 month forward contract on 10,000 pounds, okay? Now the forward rate, the forward contract is specified at 1.4416 dollars per pound, okay? So in this case, I agree that I'm gonna be buying the pounds at 1.4416 USD. And I'll be taking the pounds, I'll be buying the pounds in 6 months time, okay? So that's what a long position, a 6 month long position means. So in this case, I'm gonna write my forward rate at 1.4416 USD per pound, okay? I'm going to also call the spot exchange rate at the time that I have to settle the contract. In this case, 6 months. I'm going to call this rate ST, okay? So on the horizontal axis, I've got ST, which is just the future spot rate. On the vertical axis, I've got profit and loss in the futures, in the forward position, right? Forward profit or loss. Now, if I am going to draw a function for a long forward position, it will be an upward sloping line, right? So this is my forward rate, which is 1.4416. And why is it an upward sloping line, right? So remember that this is a long forward, so I have already agreed to be buying 10,000 pounds at 1.4416 per pound, okay? Now, suppose that in the future, in 6 months' time, this is when I will be settling my contract, right? So in 6 months' time, I'll be buying the pounds. Now, suppose at that time, if the market rate, if the spot exchange rate becomes 1.5, okay? So if you think about a person who does not have a forward contract, if that person goes into the spot market to buy the pounds, they will be buying the pounds at 1.5, okay? In contrast, because 6 months ago, we have already agreed on a price of 1.4416, okay? That means for us as a person with a long forward position, we are better off relative to the market because we could buy the pounds at a cheaper rate, okay? Whereas everyone else in the market who does not have a forward contract will be buying the pounds at 1.5, okay? So in this case, if I have a forward contract, I will be better off relative to everyone else in the market. And for a 10,000 pounds position, I'll be better off by 584 USD, right? So where does that number comes from? So the amount that I am better off relative to the market is the difference between the price that I buy the pounds at and the price that the market buys the pounds at, okay? So it will be the difference between 1.5 and 1.4416. Okay. Now, at a nominal amount of 10,000 pounds, this will equate to 584 US dollars. Okay. So this is the amount that I am better off relative to the market. Okay. So this is my payoff, or this is my profit. Okay. In contrast, if the market in 6 months' time, if the market moves to 1.4, what will happen to me, right? So if the market moves to 1.4, in this case, everyone else will be buying the pounds at 1.4, and I'll be buying the pounds at 1.4416, right? That's because I have already agreed, I already locked in my rate using the forward contract, okay? So in this case, if the market rate depreciates, I will be worse off relative to everyone else in the market because everyone is buying the pounds at a cheaper rate, okay? So the amount that I am worse off by is given by the difference between the market rate and my forward rate, okay? Times my nominal amount, which is 10,000 pounds. Okay. So to summarize, if I want to calculate the profit or loss of a long forward position, in other words, if I want to compute the payoff of the forward position, it will be the difference between the market, the future spot market rate, and my forward rate, okay? So whenever the market price increases, I will be better off relative to everyone else in the market because I'll be buying at a lower rate. So in that case, I will have a positive payoff, okay, under the long forward position. In contrast, if the market rate depreciates in the future, I'll be worse off relative to everyone else because I already agreed to pay a higher price, okay? So for a forward position, for a long position, my payoff function is ST minus F, okay? With ST being the future spot rate and F being my forward rate. Okay. So for a short forward position, this is the opposite to a long position in the sense that we agree to buy the currency for a future delivery at a fixed rate, right? So in this case, sorry, we agree to sell the currency at a fixed rate in the future. Okay. So with a short position, this is when we sell the currency at fixed rate, which is F, for a future delivery. Okay. So in this case, I'm going to be starting with the same graph as before to illustrate to you the profit and loss of this position. Now on my horizontal axis, I will still have SD, which is the same as before. This is the spot exchange rate at maturity, right? So the spot exchange rate when my forward contract expires. In this case, 6 months, okay? On the vertical axis, I've got the profit and loss of the forward position, okay? So with a short forward position, it's a downward sloping line. So where the line crosses the horizontal axis, this is where my forward rate is, right? So at this rate, if the spot rate is equal to the forward rate, then I either make any losses or any gain, right, in my forward position. Now, if the market price, if the future market rate is lower than the forward rate, what happens here is I'm going to be better off, right? In contrast, if the market rate is higher than the forward rate, I am going to be making a loss, okay? So positive profits and negative, okay? So why is that the case? Now, if we think about a person with a short position in the forward contract, this person agrees to sell, right? So in this case, we agree to sell the pounds. So we'll be selling the pounds at the forward rate, okay? So when the market rate is lower than the forward rate, this means that the market is selling the pounds at a lower rate than me. So everyone is selling the pounds here, whereas I sell the pounds here, right? So in this case, I'm better off relative to everyone else in the market because I can sell the pounds at a higher rate, okay? So in this case, my short position will pay off. In contrast, if the market price is higher than the forward rate, at the time that I settle the forward contract, that means everyone else in the market will be selling the pounds at a higher price, and I'll be selling the pounds at a lower price, right? So in this case, I'm worse off relative to everyone else in the market. So as a result, my payoff function is given by the difference between F and SD, right? So whenever the spot rate is lower than the forward rate, so if the future spot rate depreciates, then I'll make a profit, okay, in a short forward position. But if the spot rate is higher than the forward rate, I'll be making a loss, okay? So to summarize, with a short forward position, this will be your payoff function, okay? So F minus SD, with F being your forward rate and SD is the future spot rate, okay? Okay, so to illustrate how your position might change when you have a forward contract, let's look at this example over here. So this example is tutorial question 2, okay? So in this case, we have a foreign exchange trader with a US bank, and they just took a short position of 5 million pounds, okay? So the commodity currency we're dealing with is the pounds in this case. Now the exchange rate between the USD and the pounds is currently 1.55. That means the spot rate at the current time is 1.55 USD per pound. Okay. In the future, the exchange rate has changed to 1.61. Okay. So the future spot rate is 1.61. So in this case, the question is the movement in the exchange rate good from the point of view of the position taken by the trader? Okay. So for this trader, they took a short position when the spot rate is this much. Okay. So when they took a short position, that means they were selling the pounds at 1.55. Okay. In the second question, we are asked to calculate how much the bank's liability has changed because of the change in interest rate, right? In other words, is the bank's position better or worse? Okay. So let's go through this example here. So in this case, what I have is that I have entered into a position when the price was 1.55, right? So at time 0, when I sold the pounds at 1.55, okay? So if I sold the pounds, if I sold 5 million pounds at 1.55 USD per pound, that means I will get a USD proceeds of 7.75 billion, okay? Which is 5 million pounds times the price of each pound. So on the sale transaction, I've got 7.75 million USD, okay? Now, in the future, when the exchange rate becomes 1.61, this is when we have to buy back the pounds, right? So in the first step, we short 5 million pounds. In the future, when the pounds becomes 1.61, we have to buy it back, okay? To deliver the pounds, okay? So just a side note, when you take a short position in the spot market, that is when you sell an asset you don't own yet, okay? So this is when you sell the 5 million pounds without owning it, okay? So in the future, and when you short the 5 million pounds, to short the pounds, you need to borrow the pounds from some other financial institutions, right? For a fixed amount of time. So in the future, to repay the pounds to the lender, you need to buy it back from the market, okay? So in this case, for this bank in question, when they buy back the pounds, the price of the pounds happens to be 1.61, okay? So when you buy back the pounds for delivery, you've got to pay 1.61, okay? So the payment in the USD is £5 times 1.61. Sorry, this is a typo. So your payment is therefore 8.05 million USD. As a result, now if we compare our proceeds and our payments, we'll find that our proceeds is a little bit less than our payment, okay? So in this case, our liability has increased by the difference between the two numbers, okay? So an increase in the liability of 300,000 USD, okay? So this exercise shows you how when you enter into a position in a in a foreign currency market, then whenever the market moves, your position, your value might change, okay? So your account balance might change because of an exchange rate movement, okay? All right, so in the next few slides, we'll talk about different purposes of using forward contracts. Now, the first thing we talk about is hedging, right? So hedging is one of the most important use for derivative contracts, including forward, futures, and options, okay? So when you say hedging, when we say hedging, that means we want to reduce our risk exposure, okay? Or in an extreme case, we want to eliminate all of our risk exposure, okay? So when we use foreign exchange rate contracts, when we use forward foreign exchange to hedge, this is when we want to hedge our foreign exchange rate risk exposure, okay? So the risk here that we're talking about is foreign exchange rate risk. Okay, so the rule of thumb for hedging is that whenever you hedge a position, you want to take a opposite position in your derivatives market, okay? So if you have a long position in the asset market, the underlying asset, you want to take a short position in your forward or futures market, okay? And vice versa. So for example, if you're going to own a foreign currency in the future, you want to long the foreign currency now, okay? So you want to long in the forward, okay? In contrast, if you think you're going to receive the foreign currency in the future, then you want to sell the contract forward. You want to sell the currency forward for now, okay? So why is that the case? Let's look at the position of each of these two parties, right? So if I'm going to have to pay someone in the foreign currency later on, so if I have a payment of say 10 million euro in the future, right? In 6 months. So if that's the case, what do I have to do in 6 months' time? I have to, in 6 months' time, I'm expecting to pay my trade partner 10 million euros, right? So in 6 months' time, I'll be going into the foreign exchange market. I'll be exchanging the Australian dollars for 10 million euros, right? So in the future, as a person who owes something, I need to exchange my own currency for the foreign currency in the future, okay? So in this case, when I exchange the currency, when I exchange my currency for the foreign currency in the future, my risk exposure here is that I do not want the foreign currency to be expensive in the future, right? So one way to make sure that I do not have to pay any extra to buy the currency in the future is I'm going to take a long position in the forward contract now to agree to buy the currency at a fixed rate for now, okay? In contrast, if I'm going to receive the foreign currency in the future, so in this case, I'm expecting to receive, say, 10 million euro again in 6 months. So when my trade partner pays me 10 million euro in 6 months' time, I will need to convert that euro back into the Australian dollars, right? So in a sense, I'll be selling the 10 million euros to acquire the Australian dollars at that time, okay? So in this case, I don't want the euro to depreciate because if that's the case, I'll be exchanging 10 million euro for less Australian dollars, okay? So one way to eliminate that risk is I'm gonna agree to sell the euro today at a fixed price that I know, okay? So in this case, I'll be taking a short forward, right? So as an example, let's look at this example here. So in this case, we are a US importer of British woolens, and we have just ordered the next year's inventory, right? So we are expecting to pay £1 million to our trade partner in the UK in 1 year's time, okay? So this is a future payment. This is a future liability. And in this case, we owe someone right? We owe someone a foreign currency. The question here is, how can we fix the cash flows in dollars? Okay, so how do I eliminate all of the foreign exchange rate movement from my proceeds, from my dollar proceeds? So the answer here is, as we saw in the previous slide, we'll be taking a long position in the pounds, okay, for a 1 year forward contract. So in other words, one way is to put ourselves in a position that delivers 1 million pounds in 1 year, okay? So I'll be taking a long forward position on the pounds for a 1 year forward contract, right? The notional amount is exactly the same as my transaction before, which is 1 million pounds, okay? So let's look at how, by entering into this forward contract, we basically eliminate foreign exchange rate risk on our USD proceeds, right? I mean, on our USD payments. So for example, suppose that for this 1 million pounds, I enter into a long forward contract at the rate of 1.25, okay? So 1.25 USD per pounds. And my contract expires in 1 year, which is exactly the same time as when I have to pay my trade partner in the UK, okay? So if I buy the pounds forward today, I'll be paying 1.25 million USD for 1 million pounds, right? At the forward rate of 1.25, meaning that it will cost me 1.25 million USD to settle this transaction, okay? So in the future, in 1 year's time, I'll be settling my forward contract. I will get 1 million pounds and I pay the bank 1.25 million USD, okay? So this is the cost of my 1 million pound purchase in the future in 1 year's time, okay? And I fix this cost at today's time by entering into the forward contract. Now, suppose that in 1 year's time, the spot rate in the exchange market is 1.2 USD per pound. In this case, if I did not have a forward contract, I will be settling, I'll be exchanging 1.2 USD for 1 million pounds, right? So in this case, to settle my obligation, to settle my payment, I need 1.2 million USD, okay? In contrast, if the spot rate at that time is 1.3, in this case, I will be buying the pounds at 1.3 USD, okay? So for 1 million pounds, it will cost me 1.3 million USD to settle the transaction, okay? So in other words, if I draw a payoff function for my forward position and my spot position, now with the forward position, I fix my obligation at 1.25, okay? So it doesn't matter how the exchange rate moves, I will be just expending, I'll be just paying 1.25 million USD for the 1 million pounds that I have to pay, right? So my cost is fixed here, okay? In contrast, for people that have not fixed their obligation, when the market rate increases to 1.3, like we saw in the last example, their cost increases to 1.3, okay? But of course, at the same time, if the market rate decreases, say to 1.2, like the first example, then they will pay a little bit less than us, okay? But the point here is, while we know our obligation for sure, which is 1.25 million USD, the people that don't have a long forward position, their obligation would depend on the market exchange rate in 1 year's time, right? So there's a bit uncertainty in this case. Whereas with the forward contract, we eliminate all uncertainty, okay? So the second use for forward contract is also for speculation purposes. And for example, I take the example from the tutorial question. This is question 12 in your tutorial next week, okay? So in this case, let's look at how people can use a forward contract to speculate, okay? So suppose the spot exchange rate at the current time, S0, is $1.95 per pound. Now the 3-month forward contract, the 3-month forward rate is currently 1.9. So if we compare the current spot rate in the future forward rate, we can see that the market is expecting the pound to depreciate in the future, right? Now, based on your own expectation, based on your own research, you are strongly confident that the future spot rate will be 1.92, okay? So you think that in the future, in 3 months' time, the spot rate will become 1.92 USD per pound, okay? Now assume that you would like to trade, you have 1 million pounds to trade, okay? In this case, the question is, how can you use the forward contract to speculate, right? Based on your expectation, based on your own expectation about the future, okay? So the question here is, what action do I need to do to speculate, right, in the forward market? And what is my expected dollar profit from the speculation, okay? The second question is, if I turn out to be wrong, if the actual future spot rate turns out to be a little bit different from my own expectations, in this case, what will be my profit, okay? So let's think about this for a moment. So let's start with drawing the payoff functions for a long and a short forward position. And based on these payoff functions, think about which position you want to take if the future spot rate becomes 1.92, right? So I'll give you guys 1 minute again. And once we think about this question for 1 minute, we can go back and go through the question together, okay? Okay, so let's go through the example together. So like we mentioned before, what we want to do is we want to use the forward contract, either buy or sell, right? So that's what we have to decide. And we want to use the contract to speculate, right? To make profits based on our own expectation about the future, okay? So on this graph here, I've got both the long and the short position. Now the straight line, the upward sloping line is my long position. And the downward sloping line or the dashed line is my short position, right? So this is my future spot rate. And I'm looking at a 3 months contract, right? I'm looking at a 3-month horizon. So my forward rate is 1.9. So for each pound, I'm going to be either buying or selling at 1.9. Okay. This is where I think the market will be. So this is my expectation. Yeah. So because it's an expectation, I'm going to write a S3 bar. Okay. So based on these two numbers, where do I want to be, right? So do I want to be here or do I want to be here? Okay. So if I take a long position and if the market turns out to be 1.92 in the future, then I'll be making a profit, okay? Because, yeah, so this is where my payoff is, right? Now, if I take a short position and if the future turns out to be 1.92, I will make a loss, okay? Is it 0, by the way? Okay, so based on this analysis, where do I want to be? I want to be on the long position, right? So because I think the future market rate is higher than the forward rate, I want to be having a long forward position instead of a short forward position. So in this case, if I want to speculate on my information, I will be buying the pound forward at 1.9, okay, for a 3-month delivery. So if things turns out to be right, then I will make a profit of 1.92 minus 1.9. So this is ST minus F times the notional amount, which is 1 million pounds. And I will get a profit of 20,000 USD. Okay. So let me just write here. So with a long forward position, my payoff function is ST minus F. Okay. So for each pound, I expect to earn the difference between the future spot rate and the forward rate. Okay. And because I have 1 million pounds, I'll times it by 1 million. Okay. So that will be my dollar profit for the entire position. Okay. Now, in contrast, if the market turns out to be just 1.82, so the future exchange rate is a bit less than what I expected, then what will be my position, right? So what will happen to my position? So in this case, if I already took a long position as before, when I enter into a long position, my payoff function is this, right? So in the future, if the future spot rate turns out to be lower than my forward rate, so in this case, my future spot rate is 1.86 and my forward rate is only 1.9, is 1.9, okay? So in this case, the future spot rate is less than my forward rate, so I'll be making a loss, okay? So how much do I lose for a 1 million pound position? It will be 40,000 USD, okay? So if we go back to our graph before, I'm just going to use a different pen color so it looks better. So in this case, if the market rate turns out to be 1.86, this is where I'm going to be, right, with a long position. So in this case, I'll be making a loss, okay? Oh, and by the way, so with this example, the difference between this example and the previous example of hedging is that with the case of speculation, you can see that when you enter into a forward contract, your position will change, right? So you will make a loss or a gain based on the market movements in the future, okay? Whereas in the hedge position, when you use the forward contract to hedge, you will find that your position will be fixed, okay? So the key difference between the two is that with speculation, you do not have a position in the asset market, okay? So in this case, you don't have any foreign currency to receive, or you don't have any foreign currency to pay, okay? Whereas with the hedging example, you already expect a future position in the asset itself, and you will just enter into the forward position to protect your own position in the underlying asset, okay? So that's the key difference between the two purposes. Okay, so with the next discussion, we'll talk about the cross rate in the forward market. So with forward cross rates, the calculation will be exactly the same as what we did for the spot rate. The only difference is, of course, we have to use the forward rate in this case, okay? So for example, in this example, I've got three currencies. I've got the USD, I've got the euro, and I've got the pounds, okay? So the prices that I have in this table are the prices of the euro or the pound in the USD, right? Or it will be per the USD, okay? But what I want here is I want to calculate the cross rate euro and pounds, okay, for a 3-month forward contract. So what I have here is I've got the euro divided by the pounds, okay? So in this case, my commodity is the pound and my measurement currency is the euro, okay? So as before, I'm going to be starting with my cross rate on the left. And instead of writing S for spot rate, I'll be writing F3. Oopsie, let me erase it. I'll be writing F3 for the 3-month forward rate. On the right-hand side, I'll be having the euro divided by the USD, which is my common currency. And I'll times it by the USD divided by the pounds. Okay. So where do I find these numbers? In the first one, it will be the per USD value for the euro. With the second one, it will be the in USD values for the pounds, right? Which is here. Oopsie. With the first one, I've got my arrow wrong. Should be here. Okay. So what I'll do next is that I'll take this, I will times this, and I'll get this number over here, right? So I'll take this, I will times this, and I'll get 1.2690, okay? An alternative way is we can do this here. So I'll take 1.4408 and I'll times it with the reciprocal of this number, right? Which means I'll times it by 1 divided by 1.1353. Okay. So either way, I should be getting the same number. Okay. So with the cross rate, when we have the bid and ask, it will be the same as before as well when we did the spot rate cross rate. Okay. So with the forward bid cross rate, the formula is here. With the forward ask cross rate, the formula is here, right? It will be exactly the same as what we did for the spot market. Okay.